Welcome to my channel, and I know you have came across videos, a lot of videos on YouTube trying to explain liquidity to you, and the most common thing that they do is to tell you that these lows are liquidity and then this high is liquidity. Yes, this is true, but this is always based on pattern base. If you want to understand liquidity, you need to understand it from the point of logic. If you understand it from the point of logic, you will be able to identify liquidity on your own by just reading the market and being able to understand why this low or why that high is liquidity instead of looking it from the point of patterns. Patterns are very, very confusing, and sometimes they can even mislead you and you get confused, and then that creates fear into you, and you wouldn't be able to take the next trade even if that was the right thing, and this makes it even more difficult. Let's get into it, and then I will be able to explain to you why these lows are liquidity. Yes, they are liquidity, but you should be able to understand why those lows are liquidity, and then why this high is liquidity. If you are able to understand that, then you'll be able to apply it everywhere. So let's get into this. So we can just start with the theory. Let's draw and then be able to understand. So we have this diagram here. Let's understand it in theory. Then we'll be able to get into the charts, and then we focus on some little examples. You don't need to complicate this because you need to only understand this whole thing here. When you understand this whole thing here, you can be able to apply it anywhere. And it's just by the fractal nature of the chart. So if you are able to understand this simple thing, this is what is happening every time in the market. If you understand within this thing where the liquidity is, all you need to do is to be able to mark this high and then this low, and then you can be able to find the liquidity within it, and all that should be able to solve the liquidity and then inducement problems. So if we look at it here, we can understand that this high here becomes a major high. It is a major high because that high has been able to take this low out. That makes this a major high, and then it creates a potential major low. Since this low is being created, it came and then broke the major high that led to this low being taken out. Now, if that high is taken out, this low now becomes a major low. So we have here to be a major high, and then we have here to become our major low. So as we broke the major high here, the question you should ask yourself is, which low led to that major high being taken out? And if you look at it, before the major high was taken out, we had this low that was created, and this low led to the major high being taken out. It broke it out. That's what I meant by being taken out. So you are going to come back, trace price back to the low that caused the break. So this should become your liquidity. It happens all the time. We'll see it in the chart. So that should become your liquidity because that's the low that led to the major high being taken out. And there are reasons, logical reasons behind this, because many SMC traders think that the low that led to the major high being taken out, most people are going to leave their stop losses so below that low. Hence the market is going to come back and clean that low before the real move comes. So you understand that this becomes your liquidity, and after that low is taken out, then you should be able to look for your entries or levels that market will tap into. There is a lot I'm going to uncover, so we'll get into it step by step. But let's start with the liquidity, because after the liquidity is taken out, you can have maybe some kind of trend line confluences, or maybe some levels here, some QM levels here that should be able to give you confluences, and you have to still wait for confirmation here, and then you can execute the trade. So I don't want us to get into so much about it. This is the first step. If you understand this, then we can use the charts to understand it more and then later exploit into it much. Because there is one thing to here. You can see this high that fed liquidity into this high. Hence, this becomes first liquidity that was being drawn for the market to sweep and then go up. That tells you that the whole of this leg, if you are able to always identify the whole of that leg, it is very, very important. That's the inducement leg. I call it the inducement leg because that leg is going to drop liquidity to the top and drop liquidity to the down. So when it drops liquidity to the top, they'll go up. This now become relative equal highs. They will sweep that to the upside, and then it now leaves the liquidity to the low here. Sometimes what they do is it can even come back and then tap on it without breaking it, dropping more liquidity on it, and then they come back to stick it all away and then run up. We will see more examples later. So let's get into the charts and then we explore more with the examples. So this is recent price action I'm just using, and mostly the liquidity is best to look at it in M15, M30, sometimes M5, depending on where the setup is. Going into the course, I will be able to let you know where to focus on. But mostly M15 is the best to tell you the structure. So let's look at it here. Now, you have to mark the structure first, but I want you to understand why this high or that high is liquidity. Then the next lessons, we will mark out the structure, because if you don't understand the structure, you will not be able to identify the liquidity. So this becomes our potential major low. Why? Because we can see that this high was being taken out by that move here, and then we created this potential major high. When this low is being taken out, then we have this high here to become a major high. So this now become a major high because the low that created it has been taken out, and the low that created it has to take a high like this out and then form that high. So that is the rules for the market structure. We'll get into that later. So now that high is taken out here. Since that high is taken out, we have a low that is supposed to be created here. This low becomes a potential major low because it has taken this out. So if we watch it now, we have a range to be able to trade. But that is from here, the first top there, to the low that is here. This is the major low. And the previous major low was being taken out. So you have to now ask yourself, which high led to this low being taken out? So you have to just look. Sometimes with just your eyes, you can see price went up here, came down, up, and then did this, broke through. These highs that led to the break of the major low here is your liquidity highs. So the market would do anything to come back and take this out before it rounds down. It happens each and every time. You see this move here, they are feeding this high with more liquidity. They are inviting more people to come into the market and sell because they always do it. They know this is where the liquidity is, because many people will now start to put their stop loss above that, thinking that because that high broke this low, then that is the strong high. It is not. That's the liquidity. So after breaking through, that becomes your liquidity. You identify that high as your liquidity, and anytime the market comes back to it, you can see from here the market came back to it, and from this place, that's where you are supposed to now wait for your confirmation. And upon getting your confirmation, that is where you can take the entry. I want to make this short and simple for you to just get the idea, and then we can exploit more and more in the charts. So if we look at it here, you can see that we have here now becomes our low that was created. This becomes the major high, and we create a potential major low here. This low could have still been taken out, but it becomes potential. So we identify this now as our liquidity. If that low is not taken out, if that high, I mean, is not taken out, don't try to get into the market. If you want the real move, if you want to get into the real move, don't try to get into it. So from here, you can now start to combine things. I add trend lines, I add liquidity, and then I also add a structure, and I have setups that I have to wait for, and then confirmations. So from this place, the market gave a very nice setup and then structure. And if we go to the lower time frame, what we are talking about is even inside here, that you can be able to still identify that this particular high was what liquidity, and then you'll be able to take the trade from here. So based on that understanding, we can see, okay, here to that we have this low here. Now we are inside that zone from in M5 to be able to understand, using the same understanding, this high becomes a major high because it took out this low, and this low went all the way to take this high out. So that becomes our major high, and then we draw across like this. Immediately we draw that, we'll be able to find the high that broke it. And in this case, you are considering the wicks. You are considering the wicks, not the body. So from here we trace to the higher, and then from here we come all the way down. Now the high that caused the break of this, you can see it broke. That high that broke it becomes the liquidity. So that particular, you can see that high is even exactly the M15 liquidity, and from here they took that high out exactly there, and then market ran away. So it's the same thing they're going to repeat in the higher time frames and come to the lower time frames and then repeat it. It's the same theory repeating every day. You just have to wait, and for your confirmations you wait for the exact moment, and then you pull the trigger. So this is my first video. I will be doing a lot of videos on liquidity. I will do on structure. I will do more videos on refinement, and that is precision. And then you still have to have also setups that you have to rely on to be able to do it. We'll also go into storyline and be able to combine SMC and then SNR to be able to make sense out of the market. Peace out, and see you on the next video.